Okay, let's unpack this. We are diving deep today into a single financial instrument that is, well, it's structurally fascinating. It's everywhere in the U.S. insurance market, and yet it's often described as the most confusing policy a person can own.
Universal life insurance.
Universal life.
Yep.
Yeah. We started looking at the source material for this, and it immediately warns us. It says this topic may be too technical for most readers to understand.
Which is a powerful disclaimer, and it really dictates our mission here, doesn't it?
It does.
We're taking that complexity, the often maligned universal life, or UL, and we are going to translate its core mechanics, its really astonishing range of uses, and I think most importantly, its inherent and often hidden risks.
Right.
By the end of this, you won't just know what UL is, you'll actually understand how the engine works and, where all the potential tripwires are.
We're aiming for informed confidence, not just overwhelming you with jargon. Exactly. This isn't just about defining terms. It's about seeing the architecture of the policy itself. We want to give you the blueprint so you can understand why these huge institutions rely on this product while, individual consumers so often struggle with it.
A good place to start is the foundation. So what technically is universal life?
Let's start there.
So at its core, universal life is a type of cash value life insurance. And cash value just means a piece of the premium you pay goes into a kind of savings or investment component.
A side account.
A side account, yeah, that can grow over time, separate from the actual death benefit. But what really defines UL, what sets it apart from its predecessor, whole life, is its flexibility.
Okay, and that flexibility shows up in two main ways, right?
Two primary ways. The policy owner can adjust the death benefit up or down, and critically, they can choose to pay flexible premiums.
And that flexibility, that's the central appeal, but as we're going to see, it is also the number one source of its risk. You have the freedom to skip a payment, but the machine is still running. It's still demanding fuel, whether you pay or not.
The mechanism is everything in UL. You have to think of the policy as two distinct structures, almost, coexisting.
Okay.
First, you have the pure insurance component, that's the death benefit protection. And second, you have the cash value component, which acts like a side account, where money can accumulate tax deferred.
Let's follow the money then on a monthly basis, because this is the absolute heart of how the policy performs or fails. It's basically a ledger of credits and debits happening every single month.
Precisely. So first, the income side, the credits. When you pay a premium, any amount that's over and above the actual cost of insurance and any fees gets credited directly to your cash value.
Good.
Then that cash value starts earning interest, which is also credited monthly. That allows that savings bucket to grow.
So if I overfund it, if I pay a really large premium, that excess cash just goes into the bucket to start growing. But the debit side, that's the relentless part. That's the part that keeps running even if I turn the faucet off.
Absolutely relentless. And this is what every policyholder has to understand. Every single month, two critical debits get pulled from that cash value.
The first being the big one.
The single largest and most variable charge is the cost of insurance, or COI. This is the actual monthly cost for the death benefit. The second debit covers all the policy's admin expenses and fees.
And crucially, if you decide to skip a premium 1 month, those debits are still coming out.
They are still drawn out, relentlessly depleting whatever cash value you've built up.
I think a good visual for the listeners is to think of the cash value as a fuel tank. Your premium payments are filling the tank, interest is adding a little bit more, but that COI charge is a constant, and it's an accelerating leak.
That's a perfect analogy.
If you stop paying premiums, you are just relying on whatever's left in that tank to cover the leak until it runs completely dry.
It's self-funding right up to the point of exhaustion. And we should detail that COI because this is where the policy's long-term structure creates long-term risk. Unlike a level premium policy, the cost of insurance inside a UL policy is based on annually renewable term life insurance.
Annually renewable, that sounds ominous when you're talking about something you want to last a lifetime.
It is. It means that as you get older, your mortality risk goes up, and so the raw COI charge increases every single year.
So it's cheap at first.
It starts off tiny, almost negligible in the early years, but by the time you're in your late 70s or 80s, that COI charge can become massive. It increases exponentially.
So the key to making a UL policy work is making sure that the interest earned on the cash value, the fuel, grows fast enough to consistently outpace that accelerating leak, the COI, especially in those later years when the leak becomes enormous.
That is the entire game. If the cash value growth, that earned interest, doesn't keep pace with the rising COI, the policy owner hits a crisis point where they suddenly have to inject these huge unexpected premiums just to keep the contract from dying.
And how is that interest determined?
It's set by the insurer based on their own investment performance, but they do have to meet a contractual minimum. There's a guaranteed interest rate, which is very often set at 2%.
So there's a floor, but the actual growth rate is going to fluctuate. And this constant internal battle, the rising COI versus a fluctuating interest rate, that is the essential difference between universal life and its older cousin, whole life.
It is. Let's make that comparison sharp, because this is where the inherent risk really comes into focus.
Okay.
The whole life, or WL structure, is rigid. It's predictable. You pay a fixed, predetermined premium for your entire life. In return, the insurer gives you an absolute ironclad guarantee that the death benefit will be paid out.
And you, the policyholder, have no idea what's going on behind the curtain. The internal costs, the assumptions, it's all a black box.
Completely opaque. You just pay your set amount, and the company assumes all the risk of the market, of volatility, of rising costs.
And here is the core structural pivot. This is what makes UL a whole different animal. Universal life fundamentally shifts a portion of that long-term risk away from the insurance company and places it squarely on you, the policy owner.
It's a critical risk transfer. Because of that flexible premium model, the insurer makes far fewer guarantees about the policy's longevity. The contract is very clear. The policy will lapse. It will terminate with zero value if the cash value account hits zero because it couldn't cover the monthly COI and fees.
So if you underfund it, you carry the risk.
You carry the risk of it lapsing prematurely.
But the trade-off for carrying all that risk is supposed to be transparency, which you do not get with whole life.
That's the argument for UL. Every statement shows you exactly what you paid, the cash value, the fees, and the specific COI deduction for that month. So that transparency allows the policy owner, in theory at least, to actively monitor and manage the policy's funding needs.
In whole life, you're just trusting the company. In UL, you're participating in the management of the contract.
Right. Now, that inherent lapse risk you mentioned that caused the industry to innovate, which led to something called Guaranteed Universal Life, or GUL.
This feels like the industry basically saying, okay, we'll give you the flexibility of UL, but if you commit to a strict payment, we'll take back that lapse risk and guarantee the policy to age 100 or 121.
That is exactly what a GUL is. Insurers added what are called secondary guarantees, or no-lapse guarantee riders, to the basic UL structure, and this created the GUL product class. It's an explicit safety net against the COI outpacing the cash value growth.
So how does that guarantee mechanism actually work? What do I, the policy owner, have to do to lock it in?
The mechanism is simple, but the requirement for adherence is absolute. If you commit to paying a specific minimum premium payment on time, every time, for the defined guarantee period, say to age 121, the policy will stay in force.
It doesn't matter if the cash value account technically goes to zero.
Doesn't matter. The guarantee keeps the death benefit active. Functionally, it's like a very long-term, level premium term policy that just goes out to an extremely high age.
Okay, that sounds great. But our source material mentioned a big market event around 2008 that completely changed the economics of these GUL policies. What happened?
The problem was competition before the 2008 crisis. Companies were just driving GUL premiums down, trying to be the cheapest, down to the bare actuarial minimum to keep that guarantee alive.
Which meant what for the policy?
It resulted in policies that had virtually zero accumulated cash value. If you surrendered the policy after 10 years, you got almost nothing back. They were very, very cheap, but they were purely for death protection.
So low premiums for the consumer, but high risk for the insurer if their investment returns dipped.
Precisely. Post-2008, interest rates plummeted globally, which made holding those long-term guarantees extremely expensive for the insurance companies. They also had new regulatory requirements for capital reserves.
So they had to reprice everything.
They repriced GUL products dramatically. The trend shifted toward requiring slightly higher minimum premiums than before.
And what did the policyholder get in return for paying those slightly higher premiums?
You gained a much better financial profile inside the contract. The slightly higher premium means better funding, which typically results in superior cash surrender values if you ever lapse or surrender the policy. The internal rate of return is just significantly better. It's a trade-off that ultimately builds a greater buffer for the consumer.
But no matter what the pricing model is, the core risk of a GUL is still that absolute adherence to the premium schedule.
And this is the nuance that everyone must understand. You sign a commitment to pay that exact scheduled premium. If you miss that payment, or you pay it late, or you pay less than the required amount, that no-lapse guarantee rider can be irrevocably lost.
So the underlying coverage might still be active because there's still cash value.
Right. The policy itself is still alive.
But the safety net is gone.
The safety net against a future lapse is gone forever, even if you try to make up the payment later. That conditional nature is what makes GUL so much stricter than whole life.
Okay, so we've set the foundation with the original fixed universal life. But UL didn't stay still. It evolved to bring in market exposure, leading to two really different structures. Let's start with the one that's closest to a pure investment. Variable universal life, or VUL.
VUL is the explicit securities product. It takes that flexible UL chassis, the flexible premiums, the rising COI, but instead of the cash value earning a rate set by the insurer, the policy owner directs the cash value into separate accounts. It's almost exactly like investing in mutual funds.
Which means the policy owner is now exposed to market volatility. So VUL requires a prospectus, the agent needs a securities license, all of that.
Absolutely correct. VUL is a dual product. It's insurance plus a securities investment. The policyholder is the investment manager for the cash value.
Right.
And this creates a high-risk, high-reward situation.
Right. If the stock market funds you pick do incredibly well, the cash value could skyrocket, and it could easily fund that rising COI for decades.
But if the investments perform poorly, the cash value depletes rapidly, and that could accelerate the lapse date much faster than even a fixed UL.
It sounds like pure investment risk, just housed inside a life insurance wrapper. This led to a very, very popular middle ground that tries to capture the growth without the direct market downside. Indexed Universal Life, or IUL.
IUL just exploded in popularity for that exact reason. It offered that middle ground. And IUL is defined by the fact that the interest credited to the cash value is tied to the movement of a major financial index like the S&P 500 or the NASDAQ.
But, and let's stress this, IUL does not directly invest in the index.
It does not. It is an interest rate crediting strategy that is simply based on the index's performance.
Okay, let's nail down that distinction. If it doesn't invest directly, how does that index link actually work, and why does that give it such a huge advantage over VUL?
So the insurance company uses a complex hedging strategy, usually involving buying index options to deliver the interest. But the massive advantage, the core reason for IUL's popularity, is the concept of principal protection. Generally, after your monthly COI and policy fees are taken out, the cash value will not incur investment losses if the index it's linked to has a negative year.
Wait, let's make that really concrete. If I have $100,000 in cash value and the S&P 500 loses 25% this year, my account value is insulated from that loss minus my ongoing insurance charges.
That is the mechanism. The index-linked interest crediting hits a floor, which is typically 0% interest for the year. You lose the opportunity for growth that year, but you don't suffer the direct loss of your accumulated cash principal because the market went down. It's a huge feature for risk-averse people who still want some growth potential.
Okay, the downside protection is fantastic, but, insurance companies, not charities. If they're absorbing all that market downside, they had to be limiting the upside in a significant way. What are the mechanisms for that trade-off?
They implement what are called participation modifiers. This is the price you pay for the downside floor. Your potential interest credit gets capped or limited in years when the index does exceptionally well.
And the most common one is the cap rate.
Yes. The cap rate is the maximum interest rate you can earn in a given year, no matter how high the index actually goes. So, for example, if the S&P 500 returns, say, 25% in a spectacular year, but your IUL policy has a 10% cap.
You get 10%.
You're credited 10% interest. That's it.
And there are other ways they can modify it too, like a margin or a participation rate.
Correct. A participation rate might mean you only get, say, 70% of the index's positive return up to the cap. A margin might mean they deduct a set percentage from the index's performance first. These modifiers are how the insurer actually funds the purchase of the options they need for that downside protection.
It's a classic insurance trade. You give up the unlimited upside for guaranteed downside safety.
It is. And it's important to note IUL still retains that contractual minimum guaranteed interest rate, which is separate from the 0% floor on the index performance.
Oh, that's an interesting detail.
Yeah, it's often overlooked. IUL policies typically keep that minimum guaranteed rate, often 2%. So in a long period where the index returns are consistently poor or negative, your cash value might still earn that guaranteed minimum, giving you a tiny bit of positive growth that even the 0% index floor doesn't cover. It acts as a final safety net.
So when we talk about life insurance, I think most people's minds go to the basic stuff, covering final expenses, placing lost income, paying off a mortgage, and UL works fine for those things.
It does. But the real power of universal life, the reason it exists as such a complex vehicle, is in the sophisticated, high-level applications it serves for high-net-worth individuals, for families with large estates, and for business owners. This is where it goes from a simple expense product to a powerful financial utility.
Okay, let's dive into those high-value applications, starting with estate management. We're talking about using UL to handle massive, immediate tax bills when someone dies.
We're talking about providing what's called estate liquidity. When a wealthy individual dies, the estate can face crippling tax bills: federal estate tax, state inheritance taxes, and, critically, income tax on assets like retirement accounts. That's called income in respect of a decedent, or IRD.
Let's pause on IRD. That's a dense acronym. What exactly does that tax apply to, and why is the immediate cash from life insurance the perfect solution?
IRD is essentially income the person earned but never paid tax on before they died. Think of large traditional IRAs or 401k balances. When those assets get distributed to the heirs, they're taxed as ordinary income.
Okay.
Now, if the bulk of the estate is tied up in illiquid assets like a private company, a real estate portfolio, artwork, the executor is often forced into a fire sale of assets just to get the cash to pay the IRD and estate tax bills, which can be due within 9 months.
So the UL death benefit provides that needed cash, tax-free exactly when it's needed, and it prevents the forced liquidation of valuable assets at a bad price. It keeps the family business intact.
It's a monetary pressure valve. Another very sophisticated use is estate replacement. Imagine a business owner wants to leave a legacy, so they donate a substantial asset, say, a commercial building worth $5 million to a charity.
They get a huge income tax deduction for that donation.
A massive one. So they save a lot on taxes this year, but their heirs have now lost that $5 million asset.
Great.
The estate replacement strategy uses the income tax savings from that charitable deduction to go out and purchase a large UL policy. The death benefit from that UL policy then flows, tax-free, to the heirs, replacing the financial value of the asset that was donated. It's a very efficient, circular financial maneuver.
Moving from family estates to the business world, UL is essential for business continuity. Let's talk about business succession.
This is classic buy-sell funding. If you have a business with 3 partners, they'll have a contract that says if one partner dies, the other 2 have to buy out the deceased partner's share from their estate.
Which is critical for maintaining ownership control. But if the business is worth, say, $15 million, the remaining partners suddenly need $5 million in cash immediately.
And trying to fund that with savings or a bank loan is often impossible or financially crippling. UL is the most efficient funding mechanism. Each partner buys a policy on the others, or the company buys policies on all of them. The tax-free death benefit provides the immediate liquidity to execute the buy-sell agreement.
And this ties right into key person insurance, which isn't about ownership, it's about operational risk.
Key person protects the bottom line when a vital, non-replaceable employee dies unexpectedly, the chief engineer, the sales superstar. That loss causes immediate economic damage, and the UL death benefit mitigates that financial hit. It provides the cash flow buffer to stabilize the company.
Now let's look at its role in executive compensation, specifically the executive bonus under IRC Section 162. How does the tax code make this so attractive?
A standard executive bonus plan is simple but really powerful. The employer pays the premium on a UL policy owned by a key employee. For the employer, that premium payment is a deductible business expense.
Okay, so it's tax efficient for the company. What about the employee?
The employee has to report the premium as current income and pays income tax on that amount.
So the employee pays tax on the premium now, but in return, they get this immediate benefit that starts growing tax-deferred inside the policy. It's a highly valued perk.
Absolutely. But if the employer wants to add some golden handcuffs to keep that employee loyal, they use what's called a controlled executive bonus.
Tell us about the handcuffs.
In a controlled plan, there's a separate agreement that restricts the employee's access to the cash value for a specific period, maybe 10 years. If the employee leaves before that vesting period is up, the company gets its investment back. It turns the insurance policy into a powerful retention tool.
And then finally, split dollar plans, which sound incredibly complex because you're literally splitting the rights to a single asset.
Split dollar is a very custom arrangement where the policy's benefits, premiums, and cash values are contractually split between two parties, like an employer and an employee.
Can you give us an example of how that split would work?
Sure. In a common setup, the employer pays the premium and owns a collateral interest in the cash value equal to the premiums they paid in. The employee owns the death benefit. If the employee dies, the employer gets their premiums back tax-free, and the employee's family gets the rest of the death benefit. It's a way to provide a lot of insurance protection with a shared managed cost.
That complexity really shows how flexible this product is. But let's pivot back to the individual consumer, specifically the high earner. One of the biggest applications today is using UL, particularly IUL, as a powerful tax alternative.
Yeah.
The Life Insurance Retirement Plan, or LRRP. People compare it to a Roth IRA.
This is a massive selling point because it addresses the single biggest frustration for high earners, which is being locked out of retirement plans that offer tax-free income in retirement. LRRPs provide a path around those restrictions.
Okay, so let's break down the mechanics. How does a UL policy mirror the best features of a Roth?
They share three core tax-favored attributes. First, contributions are after-tax dollars. Second, the growth inside the contract is tax-deferred. And third, most crucially, both can serve as a source of tax-free money in retirement.
But where UL really outshines the Roth is when you look at the limitations the IRS puts on traditional retirement plans. What are those Roth limitations that UL just ignores?
Well, the Roth IRA has strict rules on when you can take distributions. To be fully tax-free, you have to follow the 5-year rule and generally wait until you're 59 and a half. If you need the money sooner, you face taxes and penalties.
And UL doesn't have those rules.
A properly structured UL contract has no such limitations on accessing the cash value. You can get to it when you need it, regardless of your age or how long the policy's been active.
And then there's the ultimate barrier for the wealthy, the income ceiling.
Absolutely. The IRS imposes strict annual income limits that prevent high-income earners from contributing to a Roth IRA at all. A successful doctor or entrepreneur making $500,000 a year might be completely shut out.
But not with life insurance.
Life insurance contracts have zero IRS restrictions on participation based on annual income. Anyone can contribute, making it a viable, unrestricted substitute for building tax-free retirement assets for the affluent.
So we've established it as a tax-advantaged vessel, but it also functions as a highly defensible fortress for assets. Let's talk about creditor and predator protection.
This is a huge benefit, especially for people in professions that are prone to litigation: doctors, lawyers, business owners. While the laws vary a lot from state to state, in many jurisdictions, the cash value inside a UL policy gets significant legal protection from the claims of creditors.
Including lawsuit judgments?
Including judgments from civil lawsuits.
So if a business owner faces a $10 million lawsuit and they have $2 million warehoused in their UL cash value, that $2 million might be completely untouchable by the plaintiff, even if their other accounts are seized.
That is the function. It acts as an asset protection vehicle. You can strategically accumulate substantial wealth inside the cash value, shielded by state insurance laws. It provides a layer of security that ordinary savings accounts or brokerage portfolios just can't offer in the same way.
The ability to access those funds during your lifetime is what they call the living benefits. The three main ways are policy loans, withdrawals, or using the policy as collateral.
Let's focus first on policy loans, since they're the primary way to get tax-free funds. When you take a standard loan against your cash value, the insurer immediately starts charging you interest.
And let's clarify for the listener why they're charging interest on what is technically your money.
It's a crucial economic point. The money you borrow is secured by the cash value, but it's no longer invested in the insurer's general account or in the index strategy. When they loan the funds to you, the insurance company loses the investment benefit, the expected return that money would have earned. The loan interest just compensates them for that lost opportunity.
That's the standard loan. But then there's a superior mechanism, often with IULs, called a participating loan. And this is where it gets fascinating, because the policy is designed to keep earning interest on the money you borrowed.
This is a key structural advantage of many IUL contracts. In a standard loan, the loan funds are moved out of the investment account and into a safe, low-interest account earning maybe 3%. But with a participating loan, because the IUL crediting is linked to an index, it's not direct stock investment, the loan is secured by the account value, but the index strategy that was already in place remains unaffected.
So if the index yields 10%, the portion I borrowed still gets that 10% interest credit. And if my loan interest rate is say 5.5%, then I'm earning 10% and paying 5.5%. I'm ahead by 4.5% on money I've already taken out.
Exactly. That is the goal. It significantly minimizes the drag or opportunity cost of taking the loan. It makes the cash accessible without torpedoing the long-term growth strategy, provided, of course, the index performs well.
But no matter what kind of loan it is, the policyholder has to be extremely diligent about that interest payment to avoid a catastrophic lapse.
This is a major risk point. The loan principal doesn't usually need to be repaid, it's just deducted from the death benefit later. But the interest payment is mandatory. If you fail to pay the interest, that unpaid interest gets deducted directly from your remaining cash value.
If you stop paying premiums and stop paying the interest, the cash value can just spiral towards zero.
Correct. The rising COI is already chipping away, and now the accruing unpaid loan interest is accelerating the depletion. If the policy value runs out, the whole thing lapses. And it's also important to note these are internal policy transactions, so they are not reported to credit agencies. Your credit score is unaffected.
Let's pivot to what might be the single most crucial tax distinction in all of permanent life insurance, which governs how these tax-free withdrawals and loans are treated: the MEC status, or modified endowment contract.
The MEC status is a line in the sand the IRS drew back in 1988. It's defined in the tax code, 26 U.S.C. section 7 intro about 2A. And it was created to stop wealthy individuals from using life insurance as a short-term, high-contribution tax shelter.
And it's all determined by the 7-year premium test. What does that test actually measure?
The IRS sets a maximum annual premium limit for every policy based on its initial death benefit. If the premiums you pay during the first 7 years exceed that cumulative limit, the policy fails the test and is forever branded as a modified endowment contract, a MEC.
And having the policy be a non-MEs is the absolute key to its most powerful tax advantages, especially for retirement.
Precisely. If your policy is a non-MAC, 2 incredible tax benefits apply. First, you can withdraw your cash value on a premiums first, then gain basis. That means you can pull out every dollar you ever paid in completely tax-free.
Okay.
Second, any accumulated gains on top of that can be accessed tax-free through those internal policy loans we just discussed. This is the entire foundation of the LARP strategy.
But the moment a policy fails that 7-year test and becomes an MEC, the tax treatment flips completely on its head. It starts to function much more like an annuity.
It's an immediate structural change. If the policy becomes a MEC, the last in, first out rule applies. Any distribution, whether it's a withdrawal or a loan, is now considered to be the taxable gain first.
Ouch.
And that gain is subject to ordinary income tax. And even worse, if you access that gain before you're 59 and a half, you could also face an additional 10% penalty tax, just like an annuity. It instantly ruins its use as a flexible, tax-free financial reservoir.
So you have to be incredibly careful not to accidentally trigger MEC status later on.
That risk is very real. Even though the test is mainly about the initial funding, certain changes to the contract later can trigger a retest, decreasing the death benefit, for example. If it fails the retest, it retroactively becomes a MEC. It really highlights the need for constant professional monitoring.
Let's quickly differentiate between withdrawals and loans. Why would someone choose one over the other?
A withdrawal is a permanent extraction of capital, and it has a direct consequence. It permanently lowers the death benefit by the amount you withdrew. A loan, on the other hand, doesn't reduce the death benefit immediately. It's only subtracted when the claim is paid. So loans are generally favored for temporary access or for income streams because they keep the policy fully intact for the beneficiaries.
But in terms of the policy's long-term health, both methods have the same corrosive effect on its future, don't they?
They absolutely do. Whether you borrow or withdraw, that cash is no longer earning the interest or index returns you were counting on. That compounding growth is lost forever. And this deficit shortens the viability of the whole plan, often forcing you to pay much higher premiums later on just to keep the policy from lapsing.
And finally, a quick mention of collateral assignments. This is a debt-focused living benefit.
Collateral assignments are used to guarantee a debt, usually a commercial loan. You formally assign a portion of the death benefit to the lender. If you die, the lender gets paid directly from the death benefit first, before your named beneficiary gets anything. It provides the lender with security using a highly liquid, tax-free asset.
For all its sophistication, universal life is a lightning rod for criticism. And when consumers run into trouble with it, the blame often falls on the structure, and frequently on the people selling it. We have to address the conflict of interest with commissions.
This is a criticism that you can't ignore. The compensation structure for agents is skewed heavily toward permanent life insurance. Agents get substantially higher commissions for selling cash value products, whole life and UL, compared to much less expensive term life.
So the commission on a $5,000 annual premium UL policy might be 4 or 5 times higher than on a $500 term policy with the same coverage.
That's right.
That creates a clear conflict. It suggests agents might push the more expensive product just for the higher payout, even if term life actually suits the client's temporary needs.
That is the perception, and it's often the reality in unethical sales practices. However, proponents of permanent insurance offer a powerful and I think often misunderstood counterargument, and it centers entirely on duration.
The factor of time, again.
Yes. It's really an apples to oranges comparison to just label term as less expensive. Term is undeniably cheaper over a short, defined period, 10, 20, maybe 30 years. But if the client has a permanent need for life insurance, a need that will exist at age 85 or 90, for estate liquidity or a disabled dependent permanent life insurance is almost always the least expensive option over that full lifetime.
Because the term premiums eventually become astronomical or the coverage just expires entirely.
Exactly. When you average the costs out over 50 or 60 years, the higher upfront commissions in UL become a smaller fraction of the total cost, and the policy is guaranteed to pay out. The key is determining if the need is truly temporary or truly permanent.
Beyond commissions, there's a regulatory tightrope that agents walk, especially with IUL, about marketing it as an investment.
This is a subtle but critically important legal distinction in the U.S. We have to be clear. Variable Universal Life, VUL, which invests directly in mutual funds, is regulated as a security. It requires a fine and license to sell.
But standard UL and indexed UL are different.
They are. IUL is categorized strictly as an insurance product under the law. Because you're not buying shares in a fund, you're just receiving an interest rate credit based on an index. IUL does not meet the legal definition of a security under the Securities Acts of 1933 and 1934.
So it's not regulated by the SEC or FINRA as a security.
Correct. So an agent cannot legally market IUL as a security or a variable security. That would be illegal misrepresentation.
Right.
However, and this is the nuance, IUL can be legally marketed and sold as an investment vehicle or a savings vehicle because of its tax-deferred growth and potential for tax redistributions. This regulatory difference lets IUL tap into the retirement and savings market without the same rigorous compliance that VUL faces.
Let's turn now to the biggest risk for the policyholder, which is really rooted in this complexity. Interest rate risk and the potential for a catastrophic policy failure decades down the line.
This risk is baked into that flexible premium structure we talked about. When an agent first illustrates the policy's performance, showing the premium needed to keep it going until age 100, they have to use an assumed illustrative interest rate. And often, that illustrated rate is optimistic.
And if the actual interest earned is less than that optimistic assumption, the COI quickly wins that internal battle.
Exactly. The cash value grows slower than planned, the rising COI charges create a massive deficit, and the policy owner is then forced to pay a huge catch-up or rescue premium just to keep the policy from lapsing. This isn't theoretical. This caused a massive crisis historically.
The policies that were sold in the mid-1980s are the textbook example of this, aren't they?
They're the classic case. UL was launched when interest rates were extremely high, often 12% or more. Agents illustrated policies assuming the cash value would earn these perpetually high rates, sometimes 10% or higher.
Which let them show deceptively low premium requirements.
It did. But as global interest rates began their long, slow decline through the 90s and 2000s, those policies failed spectacularly. When the credited interest rate dropped to 5% and then 4%, the cash values just couldn't keep pace with the COI, which kept marching upward as the insured got older. Policyholders who thought they had a paid-up policy suddenly got notices demanding thousands, sometimes tens of thousands, in catch-up premiums just to avoid lapse. It created profound financial shock and mistrust.
And the 2008 stock market crash only made this worse for newer policies.
Precisely. The crash lowered investment returns, which lowered the credited rates on fixed UL policies. Even for IUL, the years after 2008 saw market caps lowered, reducing the upside potential. All of it meant policyholders had to pay more or accept less to meet their original goals. The internal engine was just starved of its expected fuel.
Finally, let's go back to the no-lapse guarantees, the GUL safety feature. We need to be absolutely explicit about the hidden risk of losing that safety net, even if you keep the underlying coverage active.
The no-lapse guarantee is a contractual safety net, but it requires surgical precision. The guarantee is tied irrevocably to a meticulously calculated expected premium stream. This means paying the exact amount on the exact date every single time.
So if I pay $10 less than I'm supposed to, or I'm 1 week late, what happens?
The crucial nuance is that any failure to meet that stated schedule, even once, violates the writer's terms. The no-lapse guarantee can be lost entirely, and in many contracts, it cannot be reinstated. The underlying policy might still be enforced because the cash value hasn't hit zero yet.
But the absolute protection against a future lapse, the one thing you paid a higher premium for, is gone.
It's gone. And the final sting. Policy loans or withdrawals also nullify these guarantees.
They almost always do.
Taking a loan or withdrawal alters the internal mechanics the guarantee was priced on, immediately invalidating the writer. The complexity of UL means every single decision, a premium payment, a loan, a withdrawal, has an irreversible consequence on the long-term viability and cost structure. It places the entire burden of management on the policyholder.
This deep dive has really illuminated the duality of universal life. It is a highly powerful, sophisticated financial instrument. It offers unparalleled flexibility, unique tax advantages if you structure it correctly, and robust asset protection.
But that utility is inseparable from its complexity.
Exactly. It demands constant informed attention. It requires strict adherence to funding schedules if you're using guarantees. And it hides these tax traps, like the MEC test, that can instantly ruin its utility. It really is a high-performance machine that requires a skilled operator.
That synthesis is spot on. UL is a powerful warehouse for wealth, but it's high maintenance. And to give a final insight into just how structurally sound and essential this product is at the institutional level, I want to share a surprising fact that takes us completely out of the individual retail world.
We're talking about bank-owned life insurance, or BOLII.
Exactly. Bank-owned life insurance. BOLI is permanent cash value life insurance, overwhelmingly structured as these current assumption UL policies, often bought with a single massive premium. Banks use this BOLI portfolio to fund employee benefits. Now, here's the surprising statistic. The single largest asset class for nearly all of the largest commercial U.S. banks, think JP Morgan, Bank of America, is not treasury bonds or commercial loans. It is this permanent cash value life insurance.
That is staggering. These are institutions with armies of financial analysts, and they are prioritizing this highly complex product as their single largest asset.
They accelerated their BOLI purchases dramatically during recent economic crises because it's considered the single most secure, high-quality investment available to them.
Why?
Because the cash values grow tax-deferred, the death benefits are tax-free, and they are immune to the marking-to-market requirements that affect other assets, like bonds or stocks. One chief financial officer of a major bank described BOLI as a constantly resetting municipal bond that I never have to mark to market.
A constantly resetting municipal bond. I mean, that is the highest possible compliment you could give a financial product in the institutional world.
It is. So here's a final provocative thought for you, the listener, to mull over. If the most sophisticated, risk-averse financial institutions in the world, banks with tens of billions in assets and infinite due diligence capability, actively use universal life as a foundational, secure, tax-advantaged financial warehouse, what does that imply about the inherent structural value and complexity of the product? Is that complexity merely the necessary gateway that you have to navigate to unlock that extraordinary financial utility for yourself? Something to consider.